Hi everyone, I am Kanika and welcome to my channel Value Investing with Kanika. You must have heard about mutual funds, hedge funds, ETFs, pension funds and thought what do all these mean? So are you confused about all the fund options available there or ever wondered why some funds grow fast while others stay stable? So in this video, I'll explain the main types of funds in simple language so that you can make smarter money decisions. So first of all, what is a fund? Fund is a pool of money allocated for a specific purpose like investing, saving for retirement or growing a business. It's often professionally managed to generate return for its investors. Types of funds. The first is the mutual fund. Mutual funds is a professionally managed investment scheme that pools money from many investors to invest in stocks, bonds and other securities depending upon the objective of the scheme. So a fund manager with the help of a research team takes all the decisions like which companies to invest in, percentage of each stock in portfolio, when to exit and so on. They charge an expense fee for this. Each investor owns units which represents a portion of the holdings and the value of each unit is known as net asset value NAV, which continuously changes to reflect the changes in the value of the portfolio. So depending upon the type of investment, there are three types of funds: equity, debt and hybrid. Equity funds invest in stocks for long-term growth. Debt funds invest in bonds and fixed securities. They are short-term and low risk. Hybrid funds invest in both equity and debt. So there is a balance between risk and reward. Also, based on the type of structure, there are two types of mutual funds: open-ended and closed-ended mutual funds. So in case of open-ended mutual funds, you can buy or sell units on any business day from the fund house at their NAV value, and you can buy any number of units. There is no constraint on the number of units to be purchased or sold. Whereas in case of closed-ended mutual funds, you can invest only during the new fund offer NFO, and after that they can be traded on exchange. And there is only a fixed amount of units that can be traded. Ended mutual fund, there is a fixed maturity period, they have low liquidity. So open-ended mutual funds are more suitable for SIPs doing gradual investing, and closed-ended are suitable for long-term investors seeking stable capital. So I'll show you a few examples of the mutual funds. This is not a sponsored video, I'm just showing you the examples for your understanding. So this is a website of SBI mutual funds. You can see here there are three categories: equity, hybrid and debt funds. SBI small cap fund, which is an equity fund and it's an open-ended fund. So you can see all the details here: returns for regular growth, direct growth, date of allotment, also the portfolio breakup. So this is a sector-wise allocation of this fund. Like they have allocated 13.08% in financial services, 11% in capital goods, consumer durables, derivatives, cash and cash equivalents. Also, you can see the top holdings, and if you want to go into more details, you can have a look at their document section where you can see all the stocks which they have bought. SBI Magnum Gilt Fund, which is a debt fund, open-ended. And this is the portfolio breakup. These are the top holdings: Government of India, State Government of Maharashtra. And you can see here in sector allocation, 98.13% is in sovereign bonds and cash and cash equivalent is just 1.87%. SBI Equity Hybrid Fund. This is the allocation. Next is the exchange traded funds, ETFs. ETF is an investment vehicle that pools money to invest to track an index, commodity or a basket of assets. It's a passively managed portfolio to replicate index performance rather than outperform it. So it can be traded throughout the day just like stocks. So I'll give you an example. So this is Nippo India Mutual Fund ETF. So these are the ETFs of Nippo India Mutual Fund: equity ETFs, debt ETFs and commodity ETFs. Nippo India ETF Nifty 50Bs. So this is an open-ended index ETF, and this is the industry-wise allocation of this ETF: banking, software, petroleum, automobiles, FMCG, finance, telecom, construction, pharma, biotech and retailing. So the banking holds the largest share, and these are the top 10 stocks in this ETF. Next is the hedge funds. Hedge funds is an investment vehicle that pools money to invest in assets, products and geographies. So they have more flexible investment strategies than mutual funds. Since there is a minimum capital requirement in hedge funds, so who are the investors there? These are wealthy individuals, HNIs, institutional investors like insurance companies, pension funds. They use leverage, which means use of borrowed money and investors' capital to invest to increase the potential returns, which also increases the risk. So they invest in equity, debt, derivatives, which is futures and options, use short selling, which means selling a security which it doesn't own, real estate. So they hunt for opportunities to make money for their investors wherever possible. So these are some of the top 10 hedge funds in India. Avengers Absolute Return Fund, ICICI Prudential, IIFL Special Opportunities Fund, Alchemy High Growth Fund. Alchemy High Growth Fund managed by Alchemy Capital is a long-standing PMS strategy in India that focuses on generating long-term returns, and it typically holds a maximum of 25 stocks. So you can see on their website, so it's an open-ended fund and the tenure was 3 to 5 years, and it was launched in 2002 with a minimum investment of 50 lakh rupees. Next is the Venture Capital Fund. So they invest in startups with high growth potential. They take high risk for high rewards. Venture capitalists bring managerial and technical expertise along with the capital to the investee company. So these are the venture capital firms in India: Bessemer Venture Partners, Kalari Capital, Bloom Ventures. You can see on their website as well. So these are the funds. They have also specified the sectors in which they invest, like agri-tech, AI, cloud tech and DevOps, consumer tech. Next is the private equity firms. So private equity is the funding available to companies in early stages of growth, expansion or buyouts. These companies could be privately held or publicly traded. So private equity firm acting as the fund manager raises capital from the institutional investors, invest in private companies. They actively engage in the management and business operations to increase their valuation, and then they exit. So the firm earn their management fees. So the duration is typically 10 years or more. So these are some of the top private equity companies in India. There are both international as well as domestic players: the Carlyle Group, Bain Capital, TPG Growth Capital, the Blackstone Group, KKR Company. KKR is a global asset management firm including private equity, real estate, infrastructure. So you can have a look at their website. The current statistics is they have already invested $173 billion and $55 billion is available to invest. And these are their strategies. Next is the pension funds. Pension funds is an asset pool meant to generate stable growth for long term. So they provide retirement income for employees. They are professionally managed, they control large capital and are some of the largest institutional investors, like the National Pension Scheme, Employer Provident Fund, EPF. So these are the funds we learned today. So each one has a different goal, from growing your savings to funding a new business. So if you learned something new today, please give a thumbs up and don't forget to subscribe for more such finance videos. Thanks for watching. See you next time.